And welcome to the Dorsey Report. You can find out more about me at Google Sites, StockTwits, or Twitter. And today's report is for January 12th, 2015. We're going to be covering weekly edges, looking at some S&P 500 charts, looking at relative sectors and assets, COT, sentiment, and search. And for our premium subscribers, we'll be doing a volatility forecast, looking at C-suite status, and going over some hot picks. And as always, if you like what you see here, please like and share this video and subscribe to my channel. Thanks. Alright, for the week ahead, we've got a couple things to keep an eye on here. The week, just like last week, but slightly different, is chock full of Fed speakers. FOMC member Coach Lakota is going to be speaking on Tuesday and Thursday, as well as Plosser on Wednesday, and looks like we have Bullard wrapping up the very end of Friday. So lots of Fed gum flapping and jawing, and you know what that usually does. So that gives us one bullish edge for the week. We also have quite a bit of big earnings coming out. Alcoa is today at the close. That's always the big kickoff, although it doesn't usually have that much of a market impact. But what's bigger to keep an eye on will be KB Homes, giving us a leading indicator on home building activity, and big banks JP Morgan Chase and Wells Fargo on the 14th, as well as Bank of America, BlackRock, and some other banks on January 15th. And then we have Goldman Sachs on January 16th. So a week full of bank reports. If we were in the middle of a financial crisis, this is when we'd expect to see some big quarterly losses, but Dorsey and Intel is not expecting any of those. We're expecting the typical earnings season, buy the rumor, sell the news kind of a rally. So it looks like we have two big bullish edges for this week. All right, on our SPY S&P 500 2-hour chart here, we have some interesting developments. Looks like we have quite a bit of outperformance by U.S. long bonds. These are the futures here, the ZBs. And usually big time outperformance here, almost 4% over this window here, going back several days. That's usually a bullish sign. Also, we have the US dollar yen is also outperforming quite handily, another bullish sign. And then we do have Coke kind of lagging on the downside, so that's something to keep an eye on. A little bit of a demerit there. And high yields are right here with the S&P 500 price action. As far as the price action itself, we are flirting right now with some key levels. Looks like we're trying to break down below the key June baseline at 202.87 on the SPY, although we've yet to see a full long-term candle close below it, so we'll reserve judgment. Also, we've got a key Bollinger Band level, it looks like right there at about 202.87. So keep an eye on that 202.87 area. We definitely want to see some price action above it to become bullish again. And as far as the RSI goes, we are below 50, quite a bit below 50. So keep in mind that this 2-hour forecast is giving us a look ahead for about a month on just the daily SPY. So that means that we should be probably leaning bearish on the momentum for the SPY on a 1-month basis. However, on a 1-week basis, using the 30-minute chart, we've got a slightly different view here. Well, the RSI is low in the 30s. It does look like our MACD histogram is putting in a nice upward slope. Our fast and slow lines are definitely bottoming out, looking like they want to turn up. So as soon as we see this thing really turn up, we're going to be doing well. Plus, it looks like that's actually positive divergence here on the RSI line going all the way up. So that's a positive sign. Also, we have U.S. long bonds are way above. You can see them kind of fly off the chart here at the top. So that's a very bullish sign, as well as Coke and high yields are far above our actual price action. And even the U.S. dollar yen is up there above these key levels. So on the 30 minutes here, key levels look like 204.17. And then also just below that at about 204, we'll call it 204. We've got our 33 EMA and our 20 moving average that the Bollinger Bands are based on. Looks like we are in a negative Ichimoku cloud phase. However, I am expecting some kind of an early bounce here once perhaps our earnings start coming out or the Fed speakers start up their magic. So it looks like things are definitely more bullish, more upside prospects on the 1 week basis, but be a little bit wary as we start to move out towards more of a 1 month range. In relative sectors and assets, we're ranked by 1 month performance here, and we're seeing a lot of strength and volatility right now, which is surprising because usually this is the worst performing asset on a longer term basis, if you want to call it an asset. But it looks like volatility has really been a tear here, up 16.5% for the month. Relative strength still very strong, and it's well above all its moving averages. We also have the U.S. long bonds, which we've been keeping an eye on, doing very well here. As well as China, the gold miners, home builders, real estate, and the US dollar. So a lot of strength in all those categories. Although if I were to take a pick, right now it would be the gold miners. Very strong RSI, almost 67, well above the moving averages, yet on the quarter it's actually still negative. So a lot of value prospect there with the GDX, the gold miners, which is also a statement about gold. As far as our major laggards, we're looking at European ETF, European large caps, but it also includes pieces of Japan, Canada, Australia, so more of like non-US large caps. However, we're seeing a lot of stress there, just really ugly numbers. Japan is also struggling, as well as oil producers and XLF, the US financials. So definitely, if you're going to hedge out, I would hedge out, buy puts, or sell any of those assets. Taking a look at our very major bread and potatoes asset classes here, we're going to start with the S&P 500 for stocks. Looks like our commitment of traders hit a net short low here of about, we'll call it negative 30,000 contracts, and it has been coming off. So that's usually something you see when either you're bottoming out or you're in the middle of some type of a down movement. But as soon as we see this really start to spike up above zero, that's going to be kind of our ultimate indicator that it's time to not be long stocks. So still have some breathing room. In terms of sentiment on StockTwits for the SPY, we are still at a very neutral reading here, about 52% bullish. So that means that we could have plenty of upside to get back up to kind of a contrarian level of, say, 68%. So it looks like kind of mid-upper 60% bullish. That would be a sign that too much enthusiasm in stocks, time to start selling. So quite a bit of upside there still. And then in terms of Google search interest, usually the higher the better on here. Right now we're kind of a middle ranking of 54 if you look at the last few years. So not much intel there. If we see this really start to dip, that's going to be a warning sign. But as long as it stays elevated, we should be in good shape still. So it looks like stocks overall are shorter term bullish with room for caution as we move outward. And then moving out to our other bread and potatoes asset, bonds. Looks like the smart money commercial hedgers are net long, and they have been net long for several weeks now. Basically flat the last couple weeks, so not much of a development there. In terms of sentiment, take a look at the TLT, and looks like we're also very neutral here, 52% bulls, 48% bears. And on a relative basis, this is a very low reading. We are at some very bullish sentiment much earlier. So if you're taking a contrarian perspective on that, that's a positive sign for U.S. long bonds as well. And if we look at what search interest has been like, this is actually inverse relationship. The lower this indicator goes, generally the stronger the buy signal for bonds. The higher it goes, it's usually a sell indicator. As we saw here back in 2011, we had some very large spikes, which were actually the top of the bond market at the time. However, right now we're relatively low, down at 41, and we just printed 52 for the last week. So on a relative basis, that's still very low, which means that bonds are actually pretty good value buy right now. So it looks like in terms of search interest, U.S. long bonds do have an edge over treasuries. Definitely have, or sorry, over stocks, U.S. stocks. And in terms of the commitment of traders, also looking more positive for the U.S. long bond. And sentiment for both is neutral. Alright, for our volatility forecast, looks like we are on our 9th day above the 33 EMA. So that puts us at a fairly extended level for this VIX rally. We are continuing to make lower highs, however we are still managing to hold the rising moving averages, so still kind of a stalemate there. However, the rate of change, we're also seeing a series of lower highs. So it looks like volatility's time in an elevated state is limited and dwindling down. If we look at our probability chart, we're right here at day number 9. So it's only up in the 60th percentile. Looks like we could go for another 4 days to get us up into the 50th percentile. However, at this point, we should be looking for sort of our peak volatility within just the next few days. As far as January as a month goes, it's actually seasonally more volatility. You usually get 11-day volatility rallies before you hit your peak, and also up to 21 days, so up to a full month of volatility above trend. So January is a little bit more volatile month, so it's very possible that we go into the orange zone, the lower percentiles, but we reserve judgment until we really see some price action either way. In terms of our hot picks, here we go. Here are the assets. And right now, DI likes GDX, which we covered, the gold miner ETF, on the long side against IYT, the U.S. transports on the short side. As you can see, we've had a definitive break here above the moving averages. Very nice break, clean break. We've got a lot of overhead room before the 200 moving average. In fact, if we pull back to support here and then rally up to that 200, it would be over a 20% gain just going long GDX and short IYT, just doing a nice little pair trade there. In terms of our RSI, we're at 64.4, very strong on that ratio, and all kinds of room here to converge with the S&P and the moving averages here, longer moving averages. So a very nice little pair trade there. In terms of just the sectors, like in XLV Healthcare versus short XLF, the financials. Huge move here off of rising moving averages. This thing there's nothing bearish at all about that chart. RSI is extremely strong at 70.8. Might not be the best time to enter this particular trade. You might want to see a little bit of a convergence back down to the moving averages, but as far as a long-term bet, you really can't go wrong on this one. So long healthcare, short U.S. financials. And finally, my stock pick is Qualcomm. These guys have been having some legal IP issues for quite a while over in China. However, like with any legal arbitrage, usually there's a lot more bearish scenarios priced in, and usually when you see these things break out, it's huge. Very nice EBIT over EV, very solid dividend. Nice low peg, 1.57, and yeah, there's really everything to like about this stock. Price action is above the moving averages, RSI. Once we see that push above 55, 60, and we break out of this channel and above the 200 MA, we'll call that about 75.5, 76. I think Qualcomm's going to go off to the races. And we'll wrap things up with a quick look at the C-suite here. Looks like we are still plumbing the value depths here. Our fair value proximity percentile is back down 1%. We've been in very value buy territory, similar to the 12-16 lows. and the October lows back in mid-October. So it's really just a matter of time until we get some